Welcome back to another monthly video commentary series. We are unpacking the month of May, and I titled this one just like everybody predicted. And I'm being a bit tongue-in-cheek because I've been writing a lot about how most people think it's going to get worse. And if you zoom out and disassociate yourself from the headlines, market returns have been pretty good this year. But not all indexes are created equal. There's been some divergence between various indexes. We have a basket of stocks that are explaining a good chunk of performance. So we're going to get into that and what that means. We'll talk briefly about the debt ceiling. And there's some interesting trends in the economic data that you probably won't see on mainstream TV. So with that, let's get into it. I'm going to share my screen. Today is Tuesday, May 30th. Most of the data that I'm about to show you is as of the last week or two. So let's get into it. There's been a lot of talk about the top 10 or top 20 stocks explaining a good chunk of the S&P 500's performance. And that's true. So what this is this shows performance as of 1/1/23 to the end of April. So this is a little antiquated, but still I think it proves our point, where over here on the left, you're seeing how much performance is being driven by the top 5 stocks, so the 5 largest stocks in the S&P 500, followed by the next largest 14 or 15 stocks in the S&P 500. And you can see that the top 20 companies in the S&P by market cap, so the sheer size of the company, are driving most of the performance. You can also see what the smaller companies, still large companies, but still smaller companies are doing in the S&P 500. And there's a couple things here. I mean, one, it's not uncommon for a handful of stocks, of large stocks, to drive performance. But I think this is on the extreme end of that. And ideally, you would want to see a little more balance. So you would want these bars to be much more even. And I don't really have any absolute conclusions. I mean, there's been this big AI explosion. A lot of companies are diving into AI. Of course, that's chip intensive, meaning companies that make chips that go into AI technologies are really in vogue right now. And that's driving a lot of this. And it's the same players that we've seen. And I'll get into the actual names in the next slide. So if you want to unpack the companies driving this, look no further than this. So this shows the largest 30 companies within the S&P 500. And green and dark green mean that these companies are driving a huge chunk of performance in 2023. So a lot of these are big tech. You can see the percentage change on a year-to-date basis. So 1/1/23 as of last Friday's close. This might actually be a little older than this. I think this is as of the Friday before's close. I don't know what date that was. Maybe the 16th or something like that. But the point holds that a lot of these stocks, let's look at the top 7 or 8, are explaining a lot of the S&P 500's returns so far. And you can see what each individual company are driving in the form of index point returns, and then the percentage of the index's move. So amazingly, Apple, Microsoft, and NVIDIA explain almost 50% of the move in the S&P 500 this year. So if you own these names, that's great. If you don't own them, that might explain why your performance is diverging from the indexes. And down at the bottom here, you can see how the top 30 are responsible for over 400 points in the S&P 500 of positive return, and the rest of the S&P is actually detracting from the index so far in 2023. So again, ideally, you'd want to see some more balance. But again, it's not uncommon for the largest companies to explain a big chunk of performance in these market cap weighted indexes. And what I mean by market cap weighted indexes is the larger you are, the more explanatory power you have in the index return. So the larger companies, if their performance is bad, are going to detract, or if their performance is good, in this case, they're going to overwhelmingly add to performance. But there's two sides to every story, and These are the same 6 largest companies from the last graph. This is 2022 performance. So there's no free lunch in investing. It's not like you can just park in these companies and enjoy uninterrupted gains. There is the ugly side. And last year, boy, was it ugly, where you see a lot of these high flyers were down 30, 40, 50, even almost 70% in the case of Tesla. So in a short period of time, in a period of about 12 or 13 months, you're seeing Tesla down almost 70% to a almost plus 50% in a short period of time. So that's a wild swing. So of course, if you have the stomach for this, that's great. You know, we always encourage people to look at their position size, their risk exposure, because you know, a lot of these stocks work until they don't, and it's just a extremely wide range of outcomes that you're dealing with, even with large tech companies. A lot of hot debt ceiling talk. Hopefully we can put the debt ceiling pipe down. You know, this graph, I'll explain what it is, but it just points to how markets don't really care about the debt ceiling. It's just really unfortunate that Congress causes so much stress in this country. People have enough to deal with, and you know, it ends up being a big yawn for the markets in the end. And this has been going on since the beginning of time. I mean, since we instituted a debt ceiling, it's happened 80 times in a period of like 50 or 60 years. So this is nothing new. It comes, people get stressed, it goes, people forget about it. But it really is a challenge to the modern investor, because I think if you don't have a filter, if you hang on every word of talking heads on TV, if you're reading everything, it's going to be a real struggle for you to separate the signal from the noise, meaning what's important versus what is nonsense. And back to this slide, this really puts a cherry on top, how nonsensical the debt ceiling is. So basically what this is we're tracking S&P performance after the debt ceiling is raised or suspended, okay? So dark blue is after the debt ceiling is raised or suspended over a period of a week, a month, 3 months, 6 months, and 1 year, versus all periods since 1952. And you're seeing the same thing that I am. Debt ceiling suspended or raised versus all periods since 1952. It's pretty darn close. So again, I didn't mean to sound aloof to the risks out there, but I've seen this movie before. It's happened many times in my career. And people get worked up, ends up being a big yawn, and they forget about it. But it does cause stress, embarrassment. It might cause people to make irrational decisions. So I would encourage those, especially if you're managing your own money, is to go back and look at your behavior during this latest episode. And we're not out of the woods yet, but it looks like a deal, as we expected, will get done shortly. But look at your own behavior. Look at your process for filtering out information. Because we're all human cyborgs. It's all coming at us in a fire hose of information. And if you're trying to consume everything, it's going to lead to irrational, emotional decisions. Okay, let's talk inflation. So as we've noted in our blog a week or two ago, inflation is finally ebbing. There's been a normalization back down towards the Fed's 2% target. Now, I'm not saying inflation's not a thing, so don't roast me. Inflation is still too high, but the trend is headed in the right direction. So we've shown this before, and what this does is play the movie forward based on the monthly inflation prints. Okay, so this box here basically shows if we continue to get a normalization of inflation, meaning it's just slightly ticking higher from month to month, what the future path of the absolute inflation level will be over the course of 2023 and early 2024. So this has kind of been the area where inflation has been coming in each month. And if we continue to get modest increases, these large prints from last year are going to fall off. And this is the future glide path forward for inflation. Okay. So keep in mind, the Fed has a 2% inflation target. That's their bogey, which is made up, but that's their bogey. So as these numbers here come in, look for that trend towards the 2% inflation target, which will allow the Fed to be more flexible on the monetary policy side, meaning going from increases to pauses And if economic data gets softer, it gives them room to cut to help soften the blow and or stimulate the economy. And even if we get inflation that's a little bit higher, you can see how that plays out too. And again, still a lot of these higher prints are going to fall off. And even if we run a little hotter from month to month, you can see it probably won't be catastrophic from the overall level, given some of these bigger numbers up here that are going to go away. So I've had a lot of people tell me they think inflation is going to continue to go down for the rest of this year. It's really going to spike next year. And I would caution you that that's a dangerous way to think, because even the Fed, the smartest economists on the planet that are plugged into our monetary policy system, they've gotten inflation wrong. You can argue twice. They surely got it wrong in 2022 and 2021. Scratch that. In 2021, when they said it wasn't a problem, turned out to be a very big problem, and they were caught off sides. They kept rates way too low for way too long. And now a lot of people are saying the Fed is late to the party with pausing their hiking cycle. So a lot of people feel like the Fed should have paused months ago as economic data became softer. So don't get into the habit of trying to predict what interest rates do, what inflation does. Even the smartest investors, smartest economists on the planet get that wrong. What I like about this chart, it allows you to think in probability. So if inflation is hotter, what that means for the rest of the year. If inflation continues on its trend, what that means for the rest of the year. So this provides a probability or a range of potential outcomes rather than anchoring to one narrative. Okay, so what ebbing inflation or a slowing of inflation allows the Fed to do? It allows them to take their foot off the brakes. It allows them to stop increasing rates, which historically has been an inflection point. So we've talked about really two inflection points over the past 18 months. One is a natural ebbing of inflation. We just talked about that. So that's check mark one. Okay. The next is the Fed pausing and potentially cutting. But let's focus on the pause first. This is average 12-month performance following the last Fed hike. And the data set includes 1994 to the end of April 2023. And we threw a couple different asset classes in here. And these are all stocks, so various types of stocks. And overwhelmingly, when the Fed pauses, the next year's returns are pretty good across equity asset classes. Now, you can't set your watch to this. This is a small sample size during a period where stock returns were pretty good anyway, so take this with a grain of salt. But historically, when the Fed is moving from a restrictive policy to a more accommodative policy, that's good for risky assets. Stocks are risky assets. So this data would support that comment. Moving on to sentiment. So despite the S&P being up about 9% as of this recording, bonds have resumed their historical role of producing a risk reducer in a diversified portfolio. Bonds also have yield now. Bonds are up this year. Gold's up this year. But when you reconcile the positive returns of 2023 versus how investors are feeling, investor sentiment is still down in the dumps. And, I've said this before, sometimes we forget markets are humans trading with other humans. And there's a massive human psychology component in the way markets act. And I think some people talk about it, but not enough people talk about it. And that's one thing that I think that we do really well at Pure is we're tracking how investors feel, and we're backing that up with empirical evidence of how markets have responded after those periods. So what this is on the top is the bullish sentiment reading, a rolling 52-week average. And basically, when this line is going down or when it's low, people are feeling bad. There's not many people that are optimistic. And this data set started in the late 80s. And you can see where we're currently at, where most people are feeling worse than they ever have in this data set. So this goes back almost 40 years. And people feel worse now than they did during the financial crisis, which is absolutely mind-numbing to me. And I think I can talk all day about this, but I think this goes to how people get information, right? Again, we're human cyborgs. Everyone's digesting all these headlines about how things are going to get worse. And I really do think that affects human psyche, especially when you reconcile with what's actually happening in financial markets and how people are thinking and how they're feeling. So we've covered this ad nauseum. When this line gets low, future returns are pretty good. So investor sentiment works the opposite the way that you think. When people feel great, future returns tend to be lower. When people feel horrible, future returns tend to be higher. So I always say, if you have cash on the sideline or you've sold some stuff and you're trying to get reinvested, the right thing in investing is seldom comfortable. And you're probably on the right track if you're getting fully invested and you want to throw up. I know that sounds stupid, but it's historically been a pretty good mental shortcut. And this is just another survey. This is the Yale 1-year investor confidence survey for individual investors. And you can see same story here, slightly newer data set, but this is going straight down. People feel horrible. We did not do it here, but if you overlaid the S&P 500 with this, the S&P would be going in a northeast direction, right? So it'd be going up. Of course, there'd be some blips here, but this is probably pretty close to inversely correlated, meaning when this line is going down, the S&P is going up, and the same thing for this one up top here. So most people do the opposite of what they should. Investor psychology, investor sentiment, it's something that we track very closely at Pure Portfolios. All right, I apologize for the clumsiness of this graph, but I think it's pretty cool. There's an old saying in investing that the trend is your friend. And I think that's alive and well here. So what this is, it's tracking S&P 500 performance through the first 100 trading days of the year when the S&P is up at least 7.5%. And this goes back to the 50s, I believe, maybe the mid 60s. It looks like the mid 60s. Okay, so I'll say that again. That's a mouthful. So we're tracking S&P 500 performance through the first 100 trading days of any calendar year when the S&P is up 7.5% at least. Okay, so this is sorted by the best returns through 100 days. So 1975, the S&P was up 32% in the first 100 days, down to the lower returns through the first 100 days. And you can see I highlighted where we're at for 2023. We're up as of this is like a week and a half old. The S&P was up about 8%. All right. And then we track future performance when the market's up at least 7.5% through the rest of the year. And aside from the best 3 years when the rest of the year returns were negative, the rest of the year returns have been overwhelmingly positive about 88% of the time, with an average gain of 9.4%. Compared to all other years since 1953, the market was only positive about 58% of the time, with an average gain of 2.5%. So trend is your friend. I mean, that's one reason why we use a lot of trend, because there is a trend component in markets. Good markets tend to keep posting positive returns. Bad markets tend to post negative returns for the short term. So there's a component of FOMO in here, which gets back to the human psychology piece, where if you're piled in a money market fund and you're starting to see your friends get rich and make money in stocks, like, you're probably going to want in on the action. So there's a FOMO piece to this. But again, this is a pretty compelling story, especially for these middling returns. And I don't want to say the term middling, but just compared to this data set, like if you're up, the market's up 12% in 100 trading days, that's outstanding. But some of these low teens, high single digit returns, you can see have had pretty good returns the rest of the year. So the trend is your friend. Again, don't set your watch to this, but this is another empirical evidence piece. All right, now let's look at economic data. A lot of talk about recessions, a lot of talk about things getting worse, the economy slowing. It's actually quite the opposite, and this even surprises me. And I know there's a lot going on here, and I'll explain what this is, but we're essentially tracking the month-to-month trend of all of these economic data points. And we've classified them basically as making stuff, so output, employment, housing, inflation, and consumer. All right. So if you see a color green, that means the trend from last month to this month is getting better. If you see red, that means the trend from last month to this month is getting worse. All right. So this actually moves the opposite. This moves from right to left. So this is about a year ago, 5/31/22, as of the end of April. So we'll get May's data here in the next couple weeks. So this is through the end of April, all right? In the manufacturing output side, you can see 5 out of 6 or 6 out of 7 are green. And I'm not going to read these line by line. It would take forever. But you can see there's a lot of red here, and now it's starting to turn green, which is positive. Employment's the thing that's probably most mixed. So, you know, you don't have to be a genius to reconcile this. It seems like every day we're getting headlines about a company cutting headcount. So the job market is starting to soften. On the housing side, this is something no one is talking about. It's still a mixed bag, but there's green going from right to left, meaning things are getting less worse, or certainly not getting worse. So this is a positive trend for housing. Inflation, this is one piece that we want red. We want the trend to be getting worse. That means inflation is going down. So as we move this from, again, right to left, you can see these numbers are mostly getting smaller as we move to the left, which is good. That could give the Fed ammo pause here in the next month or two. And then the consumer, which has been pretty resilient. I mean, a lot of this stuff was red the last few months. It's more mixed now, but we just got some personal consumption reports, and people are still making a lot. They're still spending a lot, which if you go back and look at some of our blogs, this was a big understated driver of inflation. Americans going out and buying stuff, which we're very good at. Maybe not the most responsible thing, but we're certainly good at going out and buying stuff. And a lot of our GDP, a lot of our economic activity and metrics are predicated on us, you and I, going out and buying stuff. So this is something to watch. So goes the consumer, so goes the economy. And all this is, that just summarizes all of those data points and takes the positive trends minus the negative trends. So when these lines are going down, that means there's more economic indicators that are getting worse. If this line is green and going up, that means more economic indicators are getting better. So you can see throughout 2022, this was a sea of red, meaning the economy was getting worse. It was getting slower. Inflation was out of control. Now some of these trends are starting to flip. No one's talking about this, but I think this is pretty compelling. A potential inflection point that the Fed has managed to balance raising rates while keeping the economy on the rails. Okay, the last thing I'll say is, and I think this kind of summarizes what I've been talking about on the economy nicely. There's this notion that people think that a recession is announced, it comes, and then markets react, and now it's time to do something. That's not how markets work. Okay, I've gotten the question, what are we going to do in the portfolio if a recession hits? And I think that's the wrong question. Again, markets don't work that way. Markets are constantly sniffing out what happens next. And I think this graph showing the financial crisis from December 07 to May 2009 does a great job of summarizing that point. Okay, so this is the S&P 500 from January of 07 to December of 2010, all right? This green shaded area, call it mid-2007, marks when the US, in hindsight, was actually in a recession. You can see this goes till basically the end of 2008. So the official recession, in hindsight, right, was marked mid-2007 to call it the end of 2008. The government officially recognized the recession in the middle of 2008. And by that time, the S&P 500 had dropped darn near 30%, okay? So the market was already sniffing this out. The market had recognized economic data was getting worse. And look, the market going down coincides almost exactly with when a recession actually occurred, of course, in hindsight. But this is why people say the markets are the best forecasters out there. Like, people have all these narratives, and they can sound smart, they could be right, they could be wrong. The market's always right. The market is never wrong. So conversely, almost perfectly, the market forecasted, it sniffed out the end of the recession. So it sniffed out the end of the recession before the recession actually ended, but it could see the light at the end of the tunnel and bounced back when the recession was just announced. So there's so much to unpack here, but if you're following the news cycle, if you're taking cues from people and the way they talk and what's in the media, you are going to butcher this 100 times out of 100. Recessions announced, markets basically scream higher. That causes people's heads to explode. That's the way it always works. Okay? And look at when the end of the recession, when the government called the end of the recession, the market had already rallied almost 100%. I mean, like 80 something percent. And in an era where we can't agree on a recession, when no one can agree on what it actually means, when everybody's talking about it, I would rather take our cues from what the market is saying. And what the market is saying, again, in hindsight, is we were probably in a recession in 2022 for a good chunk of 2022. In 2023, the market is saying we're probably either in the ninth inning, the eighth or ninth inning of the recession, and the end of the recession is near. I don't care what the government says. I don't care when they're going to say it started. I don't care when they say it's going to end. I care about what investors are voting with their capital, what the market is doing. Okay. So I don't want to beat a dead horse, but it's important to understand the market is sniffing out what happens next. News cycles, economic data is like looking in the rear view mirror. The market is like driving with your head forward at 10 and 2, and you're sniffing out hazards. You're sniffing out what could happen next. So I know this went a little longer than I'd like. If you have any feedback, if you have any questions, send us a note at insight@Pure Portfolios. Thanks for watching. Thanks for listening. We'll see you next time.